Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to make a little money. My job is not just to entertain, but to educate, to teach you. So call me 1-800-743-CBC. Tweet me at Jim Cramer. We have two economies. There's the tremendous economy with amazing growth, the one that's connected to artificial intelligence. And then there's the anemic economy connected to the consumer, which seems to deteriorate by the day. Oh, it's a stark contrast. But you can't really see it by looking at the averages. They mask it. Dow declined 174 points. The S&P losing 0.50%. Nasdaq slipping 0.5 today. The AI economy just takes up too much weight in the averages. It makes it harder to see the weaker consumer economy, but it's there, lurking. It's there. Not a day goes by without something monumental happening in the AI economy. It's all the rage because business is that fabulous. Right now, for example, Intel, a once great semiconductor company that's been left behind by the AI revolution, needs money to get back in the game. Does it turn to a bank? Whoa. No. It's said to be turning to a company much better than a bank. It's turning to Apple. Now, it's not clear at all whether this is really happening. I want people to take a breath here because, you know, there's been no confirmation from either side, and I've been working to try to confirm it for about 48 hours. But it's natural to think that a distressed tech company like Intel would be seeking funds from Apple. Yes, Apple's just that rich, and it's committed to investing $600 billion in the United States. So why wouldn't some of that go to Intel if it asked? Heck, Apple could sub for the U.S. government and help pay for all that pie-in-the-sky stuff that former CEO Pat Gelsinger wanted to do with the CHIPS Act subsidies. Apple could build the foundries that Intel wanted to put up, hoping customers would follow. Okay, so let me step back for a second. That is not Apple's area of expertise. I find all of that to be fanciful. But if it could find a way to use Intel's chips or Intel's foundry, I don't know, it might be worth it in some way, shape, or form. Plus, most important, this would just be an asterisk when it comes to Apple's balance sheet. I'm not even sure it would count as a rounding error. No matter what, Intel can't be allowed to fail, but you need to know that this is the kind of chatter that happens every day because there's so much money sloshing around. What else? This morning, CoreWeave, basically a company that runs data centers for the AI era, announced an expanded agreement with OpenAI, the company behind ChatGPT, for $6.5 billion, bringing its total contract value with OpenAI to $22.4 billion. Now, can you think of any companies in the consumer economy that could sign a deal for $6.5 billion like that? I know I can't. But when the CoreWeave news broke, when I was sitting right over there at Squawk on the Street this morning, I couldn't even tell if it was worth mentioning. Yes, there's that much AI-related activity out there. I didn't want to cut into Carl and David and say, hey, guys, 6.5 billion. It just didn't seem to be worth it. Or how about Meta? Now, it's building a gigantic $10 billion data center in Louisiana. This thing's such a monster that it had to contract directly with a big utility in the state that's been on many times, Entergy, which is building 3 new gas power plants to fuel it. That's equal to 1/5 of the power that Entergy currently produces. We're hearing rumblings just today, though, about whether the regular consumers of power could be hurt by this deal. That's a new theme. Regular consumers of electricity being hurt by these humongous companies. Who ever heard of any other company impacting a state with its electricity needs? But these data center behemoths put so much stress on the grid these days that fighting them, well, let's say that we're going to be hearing about fights between consumers and tech for a long time. All right, now let's deal with the other side. Let's deal with the so-called regular economy. I have to tell you, it is rough out there, really rough. This morning, we got results from CarMax. Oh, my. The country's largest used car dealer. They were awful, causing the stock to plunge 20%. Sales were 6% below Wall Street expectations. There was an incredibly weak unit volume. Profit per car was below expectations. Big loan losses, too. Every line was suboptimal. What could help CarMax make the numbers? Well, you know exactly what. A bunch of rate cuts. Their customers need lower rates as auto loans are priced off the shorter end of the yield curve, mainly 2- and 3-year rates, ones that would come down if the Fed keeps cutting interest rates. CarMax is a very good operator, by the way, but unless rates come down substantially, I think things will only get worse for this company. People think it's a dog. It's not. Or consider KB Home, one of my favorites, excellent home builder. Plenty want to coming up later in the show. It's literally choosing to build fewer homes because it knows it's going to have a hard time selling them. Interest rates are incredibly important to the home builders, and KB Homes doesn't mince words. Rates are simply too high. Now, you could argue that mortgages are priced off the long end of the curve, 30 years. That's the bond market that's in play, not the Fed. But if the Fed could take rates down substantially, then banks could offer customers a short-term teaser rate. I bought one of those when I first got out of law school. That might breathe some life into this industry. We need more homes built because housing punches above its weight in the U.S. economy, as it's connected to so many other industries. Practically everything in the languishing pre-AI economy starts or is connected to housing. Finally, there's Starbucks, which today announced that they were laying off 900 corporate workers, as they also told us they'd be shrinking their North American store count by 1% this year. It's $1 billion restructuring plan. It's meant to make Starbucks more profitable. You could argue that this could have been done at any time, but I think Starbucks is part of the real economy. And the real economy, it stinks. I remain very bullish, though. I think CEO Brian Nichols' plan to get Starbucks back on track is terrific. And I advise members of the CNBC Investing Club in our morning meeting streaming show, do some buying. Buy. It's good to send the earnings up, not down. Autos, housing, retail, these are the foundation of our economy. You'd think these groups would be growing well with 3.8% GDP growth in the second quarter. This is the pace we learned about just this morning. But remember, those numbers that J.P. Morgan strategist Michael Semblis wrote about in yesterday's edition of the Eye on the Market, AI-related stocks have accounted for 75% of the S&P's returns, 80% of the earnings growth, 90% of its capital spending since ChatGPT launched in late 2022. And remember, NVIDIA allowed that to happen because it's based on NVIDIA. Apple alone is committed to an investment program that's actually larger than the entire commitment by the U.S. government to building the interstate highway system, which was the biggest public works project in our nation's history. Of course, this is a very tricky moment. President Trump can say that the economy is very strong, but we still need rate cuts because the part of the economy that's consumer-oriented is weak and getting weaker, even as the part that's related to AI hiring is hiring like mad. It's rolling in money. One thing's for certain. Without rate cuts, we aren't going to get more homes because some of the largest home builders, like KB Homes, would rather just buy back stock than build homes. We know the CarMax used car weakness isn't just going to stay with used cars. It'll be new cars, too. In retail, after years of retrenchment, a lot of thanks to digital competition, retailers still have too many workers, too many stores. Only an outfit like Walmart, which has the same scale as Amazon or Costco, can compete without worrying about its balance sheet. Oh, and by the way, Costco reported this very evening. The numbers were fine. Costco does not trade like other companies. We kind of knew how they were doing. Not enough catalyst. That's why it's weaker. Now, I know it sounds crazy to suggest that we need rate cuts when prices are still elevated, often in self-inflicted ways, think tariffs, and we have a very strong 3.8% GDP growth. But the strength is in tech, and there's just not much intersection between tech and the day-to-day life of our workforce or our lives, except maybe with cell phones. Here's the bottom line. The writing is on the wall for a big chunk of the economy if we don't get more rate cuts. Things are going to keep sinking. The other part, the AI part, is totally indifferent to rates. Most of these companies will never need to raise money. Even if they do, it seems like they just sell equity to their deep-pocketed business partners. High rates for them just means higher returns because they have so much cash earning interest more than any time in financial history. Patty in New Jersey. Patty.
Hi, Jim. I'm a first-time caller. Hi, Jim.
Okay.
I'm a first-time caller, but I've been watching Mad Money for a long time and truly appreciate your valuable insights.
Thank you.
I would like to know your take on Marvell Technology, MRVL. Is it at an inflection point to ride the strong AI and data center growth that we have been seeing it?
I think absolutely right. And it just announced a big buyback, and it's had a lot of insider buying. And I've got to tell you, this company has felt very maligned. Marvell is really an excellent company. Matt Murphy's done a fantastic job. It has been creeping up ever since the so-called disappointment. It was up 3.7 today. You got a winner. I need to go to Marcia in Washington, please. Marcia.
Hi, Jim. I'm a club member and second-time caller. And I'd like your opinion on Sterling Infrastructure, SPRL.
Well, this is a very interesting one. We're getting a lot of these infrastructure plays. This is a very, very good company. It has moved up a great deal. It's a civil engineer company. I think we have to wait for it to cool off, Marcia, but it is a real winner. It's just got a very high price to earnings multiple. Anyway, I do like it, though. I know it's hard to advocate for rate cuts with elevated prices and strong GDP growth, but the writing's on a wall for a big chunk of the economy if we don't get rate relief soon. And it's not good. On Mad Money tonight, I'm homing in on the housing market after recent reports from KB Home and Lennar and sharing if I think now's the right time to buy this cohort. Then I'm going off the charts to see if we're nearing a top in the market or if this rally still has some legs to it despite the last 3 days. And we covered a quest of therapeutics last week, but there's nothing better than going right to the source. All the company's top brass on to learn more about the story. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.